Okay, so we're going to talk about good money versus currency. Now, Aristotle was a wise man. He had plenty of time to think about many things. Among them was money. According to him, the ideal form of money should be portable, durable, divisible, should have a store of value or intrinsic value, should be fungible, and a medium of exchange. Now, ironically, the Greeks were just 100 years into using money, and mostly in the form of gold and silver. And even more strange is how Bitcoin mimics gold. But gold has some serious weaknesses. One of it is it's difficult to carry around in large sums. So if you have a lot of money, you would probably need a few safes to carry around with you. And two, it can easily be confiscated or stolen. This move from physical to digital is what makes cryptocurrencies, and Bitcoin in particular, so attractive. I'm going to give you a link that will explain the history of money from Mike Maloney's point of view. It's a very interesting couple of videos that you should check out. Of course, he's biased towards gold and silver. However, the illustrations are really interesting and I think you should watch them. Now what we're going to do is we're going to talk about the three fundamental problems with the status quo. Number one, digital copy. Everything is getting digitalized or dematerialized. However, there's a fundamental problem with digital or dematerialized objects. Imagine when you take a digital picture, right? There are multiple versions that can be created, copied, duplicated, and even modified. Now, wouldn't it be a disaster if digital money could be created, multiplied, copied, and duplicated or modified? That's another problem that we have. The second problem is, what happens when supply of something increases? Well, the demand-supply equation kicks in and the price goes down as you have more of it. So if the price kept on falling, the store of value would continue to diminish. And this is where a lot of problems actually happen. In fact, this is a disaster waiting to happen, as there would be more infinite supply of digital money that ultimately had no value. What if nobody told you this, that the supply was increasing? That's interesting. See, value is determined by demand and supply. Imagine what happens to the value of your hard-earned money when you don't know the people or have confidence in those deciding how much money can be supplied. And that too without your permission. Throughout centuries, we've been seeing various empires fall because of the increasing money supply. It's recorded in history, and that's why it's important to know all this. Digital money that can be controlled by a central authority, that is centralized, allows for the money to be infinitely supplied, right? In fact, today the money supply is currently the best unknown, or at worst, uncapped. This encourages spending money today and not having to pay for it for a long time. That's because people like benefits and subsidies and entitlements, but are not happy paying taxes. Okay, so the third problem is human frailty. What would happen if you stored your money at the bank, or it got robbed? Or everyone wanted their money at the same time when it wasn't there? Or the bank lent it out to questionable and risky characters? Or when you asked for your money, you're questioned and you received the wrong amount or a lower amount because of all those hidden fees? Of course, privacy issues would pop up here. Imagine the robber knew that you don't save your money in your house, but knew exactly how much you stored at the bank. He'd rob the bank, of course, and in the process get access to other people's money as well. It's much more simple for him. So this is the three fundamental problems that we have with the status quo. And that's where things are going to get more interesting. I'm going to talk about another section, which is the four fundamental issues that are taking place in the financial world. Number one is negative interest rates. It's already happening in Switzerland and Japan. They're already in negative territory. And this comic here pretty much sums it up. How do negative interest rates work? Badly. You pay to keep the money in the bank. It's basically a punishment for saving. The other problem that we have is spiraling debt. Now, China and the US have this problem as well. The Chinese are now putting strict capital controls in place. Places like Greece and Cyprus experienced banking failures and bank runs as people turned to alternative channels. So when the banking crisis was taking place in Greece and Cyprus, a lot of people were looking at Bitcoin and other alternatives to get their money out of the country or to move it. This is the problem with the banking system, and it's ingrained. The other problem is a war on cash. Now, if you're from India, you probably hear about demonetization. This is something that Prime Minister Modi of India brought into the country. But it's not only India. Places like Sweden, Norway, England, and US are saying that it's illegal to use cash now. And cash withdrawal limits at ATMs and tellers are reducing. Less cash is more taxation. Financial privacy. Well, FATCA and CRS are initiatives to help banning cash. The governments can see how you spend your money and what you buy, what services you subscribe to, and whom you spend it with. Syntax, who's going to complain? Now, the other problem is the level of depth of transactions that are taking place. Now, this is from MasterCard. Now, as you can see, MasterCard is involved in various aspects of the process, in the authorization, in the clearing, and the settlement. There are a good 10 to 20 different steps that MasterCard will put you through just so that you can make a transaction happen. But, don't you think this is much more simpler? A wants to transfer to B, the block or a lot of computers work together to confirm the transaction, and the money moves. Now, money doesn't flow properly. It sits in closed private networks owned by banks and financial institutions. And a normal person has to ask for permission and pay a fee just to move your money. Well, for you to move money, you'll have to go through a number of steps, like we see here in the example of MasterCard. And at each step, there's a possibility of a human error. There are also transaction costs at each step, and the time taken at each step as well is quite high. So what could take you just a few minutes might take you a few days. And that's the problem we have today with all these kind of transactions that are taking place. The solution? Well, it's sitting right in front of us. Blockchain. True digital or electronic money cannot be changed, copied, or duplicated, like you could with digital content. So no one can really forge it or duplicate your money. Since it's decentralized, it can be moved like information, fast, and without permission. So you gain the speed of transfer as there's no bottleneck. And it cannot be controlled by anyone, or even shut down or taken out, so there are no geographic boundaries anymore. No person to say, sorry, we don't have your money and we can't provide it to you right now. And plus, since the supply is limited or controlled, everyone knows what the supply is. It could be a perfect store of value. The magic behind it? Math. And you can do so much with mathematical formulas. Now, with cryptocurrencies, you can either solve a problem in currencies that would normally be difficult or slow. You can respect privacy, as we mentioned before. Every transaction is actually stored on a public ledger called the blockchain, a master log of all the cryptocurrency activity in the world. You can use the decentralized peer-to-peer nature, connected with a payment mechanism to solve all kinds of database problems. Now, what gives a currency value? Well, value is subjective. It's either backed by something or an asset like gold, or confidence in something like trust or someone. So what makes cryptocurrencies unique is that it gets its value from usage or utility. And we're going to be talking a bit more about blockchain and cryptocurrencies in the next section.